If you have been wondering, should I buy stocks or are ETFs better? This video is for you, and today we're cutting through the confusion. One path is simple, stable, and approved by Warren Buffett. The other path can make you rich or broke. We will also share some simple yet powerful lessons from Warren Buffett, one of the greatest investors of all time. If anyone knows how to grow wealth by investing, it's him. So let's walk through it together, step by step. What are stocks? Imagine this. You love Apple. You use their iPhone, maybe even a MacBook. What if you could own a tiny piece of Apple? That's what a stock lets you do. What is a stock in simple terms? When a company wants to grow, build new products, open more stores, or hire more people, it needs money. One way to get that money is by selling shares to the public. Each share is a small piece of ownership in that company. When you buy a stock, you're not just a fan of the company anymore. You're a part owner. You're not the CEO and you don't make decisions, but you're part of the team. If the company grows and makes money, you get to share in that success. How do you make money from stocks? There are two main ways to earn money when you invest in stocks. 1. The stock price increases, also called capital gains. This occurs when a company expands or becomes more valuable, and as a result, more people want to purchase its stock. As more people buy it, the price increases. For example, let's say you bought one share of Apple stock for $100. Later, the price goes up to $150. If you decide to sell the stock at that point, you would make a profit of $50. 2. Dividends, regular cash payments. Some companies like Coca-Cola share part of their profits with people who own their stock. They do this by paying you money, called a dividend, regularly, typically every few months. You don't have to sell the stock to get this money. As long as you own the stock and the company pays dividends, you will keep receiving these payments. Pros of owning stocks. 1. Stocks can grow a lot over time. When you buy a stock, you're buying a small part of a company. If that company becomes more successful, its stock price typically increases. This means that the value of your investment can increase, sometimes significantly, especially over many years. 2. You can invest in companies you like. With stocks, you can put your money into businesses you already know and use. For example, if you like Tesla cars, use Google, or watch Netflix, you can become part owner of those companies by buying their stock. 3. Higher potential returns. Over the long term, the stock market has typically provided investors with better returns than depositing money in a savings account or purchasing government bonds. This means your money has the chance to grow more if you invested in stocks and leave it there for a while. The downsides of owning stocks. 1. Stocks can be risky. When you buy a stock, you're buying a small piece of a company. If that company doesn't do well, the value of your stock can go down. In some cases, you could even lose all the money you invested if the company goes out of business. 2. Prices go up and down all the time. Stock prices can change every day, sometimes by a lot. This can make investing feel stressful, especially when the price drops. Many people panic and sell too soon due to the fear of loss. 3. You might not be spread out enough. If you only invest in 1 or 2 companies, you're taking a significant risk. If one of those companies has problems, you could lose a large part of your money. It's safer to invest in multiple companies, so your money isn't all in one place. What are ETFs? ETF stands for Exchange Traded Fund, but don't worry about the complicated name. It's a simple idea. An ETF is like a package that holds many different investments inside it, usually a mix of stocks, bonds, or both. Instead of buying just one company's stock, an ETF lets you buy small pieces of many companies all at the same time. Think of it like going to the grocery store and buying a basket filled with different kinds of fruits, apples, bananas, oranges, and grapes, instead of just buying one apple. In the same way, an ETF gives you a small share of many companies in one single purchase. For example, instead of buying only Apple stock, you could buy an ETF that includes Apple, Microsoft, Google, Amazon, and many others all in one go. This helps spread out your risk and makes investing easier and more balanced, especially if you're just getting started. Let's break it down with a simple example. When you buy something called an S&P 500 ETF, you're not just buying one company, you're purchasing small pieces of 500 different large companies in the United States, all at the same time. That means your money gets spread across well-known businesses like Apple, Google, Amazon, Coca-Cola, and many others. These are some of the biggest and most successful companies in the country. Instead of trying to pick individual stocks and guess which one will do well, buying an S&P 500 ETF lets you invest in a broad group of companies. If these companies grow and earn more money over time, the value of your investment usually grows with them. It's a simple way to start investing without having to be an expert in picking stocks. Pros of owning ETFs. 1. Diversification. When you buy an ETF, you're not just buying one company, you're buying small pieces of many different companies all at once. This means that if one company performs poorly, the others in the group can help offset the loss. It helps reduce the risk of losing a significant amount of money due to a single company's poor performance. 2. Lower risk. Since your money is spread across many companies, you are less likely to lose everything if one company has a problem. This makes ETFs a suitable choice for individuals new to investing or those seeking to minimize significant risks. 3. Lower fees. Many ETFs, especially index ETFs, are cheaper to own because they don't try to beat the market. They follow it. For example, an ETF that tracks the S&P 500 includes the 500 most prominent companies in the U.S. No high-paid managers are making complicated decisions, so the costs are low, and you get to keep more of your money. Downsides of ETFs. 1. You might earn less than with individual stocks. ETFs are made up of many different companies, so your money is spread out. This means your returns are more balanced. However, if you had chosen just one excellent stock, such as Amazon in 2009, you could have made significantly more money. The problem is that it's challenging to predict which stocks will perform well in advance. 2. You have less control and excitement. When you invest in an ETF, you don't get to choose which companies are included. Someone else manages the list for you. This makes it easier, but also less exciting. Some people enjoy researching companies and watching their favorite stocks rise in value. With ETFs, the experience is more passive and slow-moving. Let's further explore 5 key features of both ETFs and stocks, and examine them closely so you can grasp the differences. When you invest in one ETF, you're investing in several companies at once. This makes your investment more balanced and less risky. If one company doesn't perform well, the others can help compensate for it. Stocks, on the other hand, represent investments in a single specific company. If that company performs well, your investment can grow significantly. However, if the company faces difficulties, your investment could quickly lose value. Therefore, stocks are generally riskier than ETFs because they rely on the success of one business. When it comes to effort, ETFs are easier to manage. You don't have to spend much time reading news or financial reports. You can buy them and simply leave them alone, which is why people often refer to it as a set and forget approach. Stocks require more work. You need to research the company, understand how it makes money, monitor its performance, and keep up with any significant changes. When it comes to returns, ETFs typically grow steadily over time. They're not designed to make you rich quickly, but they can help build wealth over the years if you're willing to be patient. Stocks can rise much faster, but they can also drop just as quickly. Therefore, with stocks, there's a chance of earning more money, but there's also a greater risk of losing money. Another difference is control. With ETFs, you don't have the power to choose which companies are in the fund. The fund manager does that for you. However, when you invest in individual stocks, you are in control. You decide exactly which companies you want to buy and when to buy or sell them. ETFs are ideal for beginners, busy professionals, and anyone looking to gradually build wealth over time. Stocks, more suitable for experienced investors, hobbyists, or those who enjoy following the markets and selecting winners. Let's talk about the man known as the most significant investor of all time, Warren Buffett. He once gave an obvious piece of advice. For most people, the best thing to do is to own the S&P 500 index fund. Buffett believes this is the smartest move for the majority of people. And he's not just saying that. In fact, in his own will, Warren Buffett instructed that 90% of the money left to his wife should go into one of these S&P 500 index funds. Why would a billionaire do that? Because he knows that most people don't have time to study hundreds of companies, don't have the experience to pick the right stocks, and might panic and sell when the market drops. So, which option should you choose in 2025 and beyond? ETFs or individual stocks? Here's the simple answer. Start with ETFs. ETFs work like a basket containing many different companies in a single investment. This means your money is automatically diversified, which helps reduce your risk, especially when you're just starting out. As you learn more about how the market functions and discover the types of businesses you prefer, you can explore individual stocks later. By that time, you'll have gained more experience and feel more confident making those decisions. If this video helped you understand the difference, please give it a like so that more people can find it too. Also, be sure to subscribe if you want more easy-to-follow videos about money and investing. Tell me in the comments below, will you start with ETFs or do you feel ready to try buying individual stocks?